Welcome to the Insurance and Money Podcast. We're here to educate on the topics of insurance and money. I'm your host, Carla Howard. I want to thank you for tuning in to the show today. Today, our topic is insurance and mortgages. Why everyone needs life insurance and the different types of insurance. On this show, you can expect to learn about the different types of insurance and how they relate and apply to you. Also, we will discuss your money as well, such as checking and savings accounts, credit cards, and mortgages. On the last episode, we talked about the need to purchase life insurance on our children and how with a small amount bought at an infant to under 10 years, how that can set them up for insurance needs the rest of their life. Also, we discuss universal life as well. Today, we will discuss final expense insurance and mortgages. Final expense insurance is a whole life policy. Typically, it's easy to be approved and the amounts offered are small. The amounts that are approved are usually under $20,000. Approval is often without any medical exam and is also expensive. People 60 and over are the group that usually purchase these policies. They don't have life insurance and now understand the need to have a burial policy. You can buy it into your 70s and 80s. On the next episode, we will discuss smoker rates. So far, all illustrations I have presented are non smoker rates. Now, let's look at example one. A female, age 71, wants a burial policy. The annual premium is $631.50 or $56 a month. Female, age 62, wants the same $10,000 burial policy. The premium is $405.20 or $36.06 a month. So you can see the difference in premium. Go back and review the last episode and compare the rate on children's policies. Now, I am not recommending waiting until late in life to buy life insurance. I am definitely not. And for obvious reasons. First, you will not get a very large face amount. Number two, it will not be cheap to buy that small amount. Three, some companies that offer this coverage have stipulations, such as if you die within 2 years, all you get when the claim is filed are the premiums that you paid into it. Insurance companies believe that when you turn 70, transition or death is near. So the costs and stipulations are going to be strict. That's why I want to educate on the purpose and the need of buying young, healthy, and affordable. As a licensed insurance agent, I have seen families enjoy the benefits of having the right amount of insurance after losing the breadwinner. After burial expenses are paid, getting rid of debt and having college tuition and money in savings just change the financial fortunes of the family. And this is the real purpose of life insurance. I've also seen the horrors of not having enough insurance. The door knocking, having to go online to ask for donation to bury loved ones. All because of not taking the time to properly purchase the right policy. And I have shown in previous episodes everyone can afford it if purchased young and before any health challenge may arise. Now let's talk about mortgages. Many families are homeowners, so they have a mortgage in most cases. I always encourage people who endeavor to buy a home to put down a 20% down payment. I know that there are a plethora of programs available to get a mortgage with zero down or little down, such as 3% or 5%, etc. However, when you have a down payment under 20%, you will be required to have private mortgage insurance or PMI. Now, I want to be very, very clear. PMI does not benefit the homeowner. And unfortunately, I've run into people who actually believe it does. That, if something happens to them and they pass away, that their mortgage is paid off. It is not life insurance that will pay off your mortgage before it's paid off if you should die. We'll talk about that type of insurance in a moment. PMI only benefits the lender or mortgage company. It's a policy that the lender buys on your behalf that pays them should you default or go into foreclosure. It protects the lender or mortgage company only. So I encourage you to read your mortgage statement, and you'll find PMI in the escrow section of your statement. With PMI, the lender can recover costs associated with the resale of the foreclosed property, the accrued interest or fixed costs such as taxes or insurance policies paid before resale. Your mortgage payment will consist of interest, principal, and escrow. If when you are approved of a mortgage and you pay a down payment less than 20%, you can guarantee that you have PMI. You always want your loan to value to be 80% or less. Now, what's loan to value or LTV? LTV is a financial ratio that compares the loan amount to the value of the property or appraisal. The lower the LTV is, the lesser the risk to the lender. And the more money you put down shows the lender that you have a financial stock in the purchase. You took money out of your savings account to help make it happen. It shows that you are low risk, along with many other factors as well that we'll get into in a moment. Now let's look at example 2. You found a perfect home for you and your family. You negotiated the price down to $300,000. The appraisal came in at $320,000. So it looks like you got a pretty good deal. To avoid PMI, you will need to put a down payment of $60,000, which is exactly 20%, bringing your LTV to 80%. That's $300,000 times 20%. That's how you come up to $60,000. Now, that is the perfect scenario. And awesome, you've avoided PMI. However, many are not able to put down 20%. So how much do you have to pay? The PMI rate range is 0.2% to 2% per year. The calculation on the lower end, 300,000 times 0.002 equals $600 a year or $50 a month. On the higher end of that same $300,000 loan amount, 300,000 times 0.02%. Now that equals $6,000 a year or $50 a month. Therefore, on a $300,000 loan amount, the range that you would pay per month added to your monthly payment would be approximately $50 a month to $500 a month, and that's depending on the rate. And the other factors, of course, are credit score, debt to income ratio, as well as a few others. Now how can I get PMI to cancel? I've had my mortgage for years, and the LTV, if I can get it to 80%, how can I get that canceled? How does that work? Well, the Homeowners Protection Act of 1998, HPA, also known as the PMI Cancellation Act, was signed into law on July 29th, 1998, and became effective on July 29th, 1999, and amended on December 27th, 2000, to provide technical corrections and clarification. The HPA addresses homeowners' difficulties in canceling PMI coverage. It establishes provisions for canceling and terminating PMI, sets disclosure and notification requirements, and requires the return of unearned premiums. PMI is insurance that protects the lender from the risk of default and foreclosure. PMI allows prospective buyers who cannot or choose not to or to provide a significant down payment to get mortgage financing or affordable rates. It's also used a great deal to facilitate high ratio loans over LTV. So when your loan is 80% or lower, it can be removed. Some people refinance to get rid of it, and some pay for a new appraisal in hopes that the property value has increased and their LTV is now under 80%. But before you do that, please contact the lender before paying for a new appraisal. Get the lender's requirements. Now, on another note, some mortgage companies do offer or partner with insurance companies for if the homeowner does pass away prior to the mortgage being paid off. And the product is called a decreasing term product or mortgage life insurance. It covers the mortgage should the homeowner pass away. When a homeowner passes, the balance is paid in full. But before that happens, the benefit amount decreases as the mortgage balance goes down. The premium usually does not go down. It's not an expensive policy, but I wouldn't recommend a decreasing term policy. I would get a policy which covers all the debt and the benefit amount does not decrease, while the premiums don't decrease along with the benefit amount decreasing. We'll go over this in more detail in the next episode, and we will have other mortgage topics to discuss, such as forced placed insurance. This is an extremely important topic, and we'll get into it in great detail, as well as decreasing term insurance. Thank you for tuning in to the show today. Please tune in every Wednesday at 7 p.m., and we will continue our discussion on insurance. I have more examples and tips to share. This is Carla signing out. Until next week.